Imagine the 2026 headlines. No, not that one. This one. Places are up around 6%, auctions packed, rents are still climbing. Which city would you back with 600K today? In this deep dive, I'm going to show you the best performing capital cities, why the bubble hasn't burst yet, and where I would put 600K today. Spoiler alert, it's not where you think. Before we rank the big cities, a quick pulse check on what's happening out there in the property market today. Population is still hot. Net overseas migration was at 446,000 in 2023-2024, and the budget is set to be 260,000 in 2024-2025, and 255,000 in 2025-2026. Still a big inflow by historical standards, which keeps pressure on both rents and entry-level stock. Supply is lagging the target. Government wants 1.2 million new homes built over 5 years from July 1st, 2024, which equals around 240,000 new homes a year. But we completed 43,000 dwellings in the March quarter 2025. At that pace, we're only completed 174 dwellings per year. So we're in a deficit. The rental market remains tight. The nation vacancy rate fall to 1.2% in August 2025. Nationwide gross rental yield sits at 3.7% for housing in particular, which breaks down to around 3.5% for capital cities, and for regional towns around 4.4%. Building costs have slowed down, but building costs aren't falling. The Cordell Construction Cost Index rose by 0.5% in Q2 2025 and 2.9% over the year. More like a jog than a sprint, which means replacement costs are staying high. In simple terms, housing isn't getting cheaper, it's getting more expensive to build. Prices are still increasing. August saw the national index rose by 0.7%, with Brisbane at 1.2%, Sydney at 0.8%, Melbourne at 0.3%, Hobart at a negative 0.2%. In plain terms, where you put 600K still matters more than ever before. The national housing value rose by 1.8% in August for the last 3 months, taking the nation's median house price to $843,000. So there's a big picture for the property market. Let's take a look at it. Which capital cities are leading the growth race? I'm ranking the capital cities worst to best in August 2025 month-on-month growth. I'll call out each median house price and what 600K actually buys you. Units versus houses, inner versus fringe, so you can feel what your budget can buy you. Starting with number 8, Hobart. Negative 0.2% month-on-month growth, median house price $724,000. With $600,000, it'll usually get you a unit or a townhouse, or maybe a house in the outer fringe suburbs on the outskirts of Hobart. Number 7, Melbourne. Positive 0.3% month-on-month growth. The median house price is at $956,000. For $600,000, you can get a unit or a townhouse in the inner fringe suburbs, or potentially a house for $600,000 on the outer fringe suburbs, places like maybe Melbourne or Sunbury. Number 6, Canberra, ACT. Up 0.4% month-on-month growth. Median house price is around $1 million. For $600,000, you would normally get a unit. Houses are well above that price point. Great incomes, but tough entry level. Number 5, Sydney. Up 0.8% month-on-month growth. $1.5 million is the median house price. For $600,000, you're only going to get a unit, potentially maybe a townhouse. If you want to buy a townhouse that's something around $600,000, you're going to go on the outskirts of Sydney, probably around that 15 to 20K radius plus. Number 4, Adelaide. Up 0.4% month-on-month growth. The median house price is around $900,000. For $600,000, you can stretch to an entry-level home in the outer north or south pocket, or a townhouse if that's closer in. Number 3, Darwin. Up 1% month-on-month growth. Median house price around $654,000. For $600,000, you can buy a house in several suburbs or a better quality unit. Just note, high volatility. Number 2, Perth. Up 1.1% month-on-month growth. Median house price around $880,000. $600,000, you can buy a house on the outer fringe suburbs or eastern ring suburbs, often older stock. And number 1, Brisbane. up 1.2% month-on-month growth. Median house price just over $1 million. For $600,000, you typically buy a unit or a townhouse, or maybe a house on the outer fringe suburbs. That's a very competitive price around that $600,000. Pretty crazy to see that 2 or 3 years ago, you could buy a house in Brisbane, Perth, Adelaide, even Hobart for sub $500,000. So that's the scoreboard. What's hot, what 600K can actually buy you? Hold that picture, because in a minute, I'm gonna show you why the best performing markets aren't the best places to buy today. Before we talk about where you should buy, let's be clear on what 600K can buy you. At this budget, a capital city purchase, you'll be pushing out a townhouse or an older apartment with little to no land. You might be lucky to get something in a small capital city besides the top 3 capitals. Typically, gross yields, capital city apartments are around 3.5 to 4.5%, versus regional houses are around 4.4 to 5.5%. Annual fixed costs for apartments with strata often around that $5,000 to $6,000 per annum. Housing carries insurance rates and about 1% maintenance costs, but no strata at all. Year 1, the cash flow at 80% LVR and with a 6% interest only, an apartment will cost you roughly around $10,000 versus a regional townhouse will cost you around $6,000 to $8,000 a year to hold, with a 4.7% rental yield on the apartment and the house. Equity drivers. Apartments rely on building demand, houses have land scarcity and value-add options like renovations, sheds, second dwelling, and adding granny flats that will give extra value to the dwelling. The next purchase impact. The apartments can be more negative geared, so that can reduce your borrowing capacity for the next purchase, which will slow you down and stop you from getting into the next property ASAP. In short, same 600K, very different assets. We steer away from apartments and focus more on houses with land because they typically carry better growth and give you more ways to create equity. Before we talk about where to buy the next property, here's what 600K actually buys you in recent years. Brisbane versus Rockhampton. The past 2 to 3 years, Brisbane at 500, 600K, you could purchase a typical house or townhouse on the outskirts of Brisbane, like Ipswich or Logan. Rockhampton, a regional town, $500,000 comfortably will buy you a house on land. For example, in a suburb called Norman Gardens, we would purchase a duplex for $360,000 back in 2022 that rented out for $700 a week. That's a 10% rental yield. Property has grown by 80% since then, which is valued at $650,000. And this property was paying for itself from day one. Perth versus Geraldton. The past 2 years, Perth was a capital city. We could purchase a house for around that $500,000 to $600,000. Regular targets were older houses in the south or outer ring where it was competitive and prices were elevating very quick in 2023 to 2025. Geraldton, for example, 500K purchase, you could stretch that further into an established coastal town. For example, we purchased a house for $355,000 in 2023, 80 meters from the beach, later valued at $575,000. That's a 62% uplift across that holding. Geraldton featured as the best performing region in the whole of WA in 2024-2025. Sydney versus Wagga Wagga. In the past 2 years, Sydney, a capital city, at $600,000, you could purchase typically a unit or maybe a townhouse. Over 2021 to 2025, that window there, Sydney was one of the worst performing cities in Australia. Wagga Wagga, with a budget of $500,000 to $600,000, you can buy a house in an established suburb. We purchased this cracker property for $525,000 at the end of 2022. The property has grown 33% and is valued at $700,000 today. There is a clear shot of where we invested over the last 2 to 3 years. The magic question is, where do I invest $600,000 today? I'm going to anchor what critical fundamentals you will need to use so you can do this without a buyer's agent. Number 1, regional center size floor. Target an LGA that is a regional town with a population of 20,000 people or greater. That gives you depth in jobs, services, and rental demand. They call them regional cities, but if you look at places like Newcastle or Bendigo, for example, they're labeled as regional towns, but they're more like small cities. Number 2, diversified local economy. You have a diverse range of industries driving the economy for stability. For example, healthcare, education, logistics, ports, government jobs, manufacturing, and the list goes on. Reason why is because you don't want a single industry driving the economy and being reliant on one sector. Geraldton was a great example. 40 to 50,000 population with ports, logistics, healthcare, education, government roles alongside resources, which helped hold when Perth swung the other way and it wasn't solely relying on the mining industry. Number 3, arrivals and demand building. Look at internal migration into an LGA and a steady list of households. 70% of overseas migrants can't afford to buy a home in the first 5 years when they arrive in Australia. Look for Australians moving from work or lifestyle over a headline hype. Number 4, early into a market phase. Prioritize a market that are moving from flat or recovery markets to a rising market. You know before the open home mosh pit. If you're seeing 15 plus offers on the table and there's no room for negotiation, you know you're too late to the party. So find the next after party. Number 5, tight supply signals. Look for low vacancy rates, low new supply, and realistic building pipeline. The play is rising demand, plus limited new stock. No markets where supply can explode. Number 6, asset choice at $600,000. House on land. At this budget, in capital cities, you're being pushed towards apartments or townhouses. In the right regional city, you can still buy a house on land. Number 7, treat it like a stock market, know when to buy and know when to sell. There are over 15,000 suburbs in Australia. There are markets in markets. So look at the fundamentals and know when to get in and know when to get out. Because if you get into a market that's already had a 60% growth, you've just missed out on 60% growth on your investment property. We find a 12 to 24 month window when we invest in a market. You also don't rely on property data because it's lagging data. Number 8, what we avoid, even if it's cheap. New estates with easy, repeatable supply, single industry towns, and crowded markets where every man and their dog is there. If you look back at Rockhampton or Geraldton and these other great markets that we invested in 2022, look at their fundamentals. It will help you understand how to pick the next hotspot. To sum it up, today, we've placed $600,000 into a house in a regional city with a population grade of 20,000 people, with diverse jobs, tight supply, and early phase of momentum, and we are ready to invest in the next emerging market. Once these markets have been founded by the general public, it's time to move into the next hotspot.